to Schwab Live Daily, the last segment of our day on Wednesday. My name is Robert Kamek. I am the Regional Investment Strategist for Charles Schwab that covers the Great Lakes region. And I'm joined by my friend and counterpart, Jeffrey Abelos, the Regional Investment Strategist for, as I like to say, everything Southern California nowadays. So am I correct on that, Jeff, or
Yeah, pretty
am
much.
I close enough?
Everything from Fresno on down to Tijuana, I have a little bit of a hand in. So,
I love it. I love it. So, thank you for being on here today for our segment on behavioral finance and specifically how some of the emotions that we run into around the financial markets, around money, and how they can lead us to make some less than optimal decisions. I always think about this. I always think about that word emotion, and I think about it from this perspective. You think about emotional decisions that we've all made in our lives. Would you classify those as some of the decisions that you think are your best or the ones that you would like to do over?
most of them, I think, like a lot of people out there listening and watching, I think most of them I would like to have a second opportunity at. Um, some of them, I think, okay, you had to make a split-second decision. It worked out okay. Say you were in a sports game and, all right, I have to make this play. But there's a lot of times, especially with trading, where I just think, oh, you could have taken an extra 30 seconds and completely avoided that loss. So I definitely err on the side of taking it a little bit slower when I'm doing my trading decisions. What about you, big guy?
No, absolutely. I think you bring up an interesting, an interesting point there. In my long career, I would say some of the best traders and investors I know
Hmm.
are people that have really been able to disassociate the emotion from the decision-making process.
Yeah.
I would say, some of the ones I know, I say some of the best traders I know are almost a little bit emotionally void. I don't know if that's recommended for everybody, but something to think about.
Yeah, no, you're right. The best traders I know, they could make or lose $20,000 and you wouldn't register it on their face.
Yeah.
It's like the money's not real. It's all a process and sticking to the strategy and plan that they've set forth.
Yeah, you hit on it right there, Jeffrey. The plan, the plan. What's the plan? What's the process? So obviously, with today, a couple things we'll go over here right at the start. As we go along, if you have questions, we want to hear from you around this topic. Are there areas that we could potentially address or bring into the conversation here? Please type in your questions below. We are happy to work to get to all of them there. Secondly, uh, I don't plan on talking about any stocks today or specific strategies, but if we do realize these are from educational perspective only, not necessarily a recommendation from Schwab, not a recommendation from us. If we do talk about, ETFs, risk and all that, you have to have a plan out there. Make sure you understand exactly what you're getting into. Do your research up front. Jeff, any disclaimers you want to add to this?
Everything we talk about, education and illustrative purposes only. Please know that both you and myself, Robert and I, we don't know what the future holds. So past performance is no guarantee of future results.
You got it. Past performance does not guarantee future results. If it did, it'd be easy.
Wouldn't that be great?
You got it. Tech, thanks for the quick question. We haven't quite gotten there yet. So yes, you are correct. The PDF for this is not available in the slides. You need to get a hold of us. Please contact one of our branches, a financial consultant or associate financial consultant at the branch, if you want a copy of these slides. I will also let you know every Wednesday here for the month of June at 4 o'clock Eastern, 1 o'clock Pacific, or I guess that would be 10 a.m. Hawaiian time. We'll be having this behavioral finance discussion. So what are we really going to talk about today? We've broken this down into three big areas. We'll talk a little bit about the insights around behavioral finance, sort of how does this sort of happen? Why do we think sometimes the way we do? Why do we let emotion creep in? Then we'll get to, I think, what I call the meat or the heart of this presentation, some of the common investor biases that we bring to the table. As we are all human, what are some of these traps that we can find ourselves into? And I know, Jeffrey, you have a couple additional ones that we're going to talk about above and beyond the three that are built into this presentation. So we're going to add a little bit extra there. And then finally, we'll wrap up with what are some of the simplest things you can do to help overcome some of this emotion, some of the traps that we all can potentially fall into as either traders or investors. So that's what we have planned. Let us get started. Let us get started. So let's talk about this concept. And I love the question we have on here. So everybody out there, think about this. How many of you consider yourself an above average investor? Jeff, I'll ask that flat out to you. Do
Yeah.
you consider yourself an above average investor?
I like to think so. Sometimes my returns don't exactly correlate to that level of thinking. But yeah, I read the Wall Street Journal every day. I'm looking at the markets. So I'd like to think I'm an above average investor if you were to do a comparison. What about you?
Um, I think exactly like this. Although maybe the longer I'm in this business, maybe I have doubts. I guess I always have doubts, but no, I think I would agree with you. I personally have been in this business almost 30 years, both here at Schwab for almost 20 years, and also on the professional side of trading. And I'd like to think I've got lots of knowledge. I've learned to tamper down the emotions. I would think I'm an above average investor around that. Okay. So everybody out there, please think of this for yourself. Now let's take this one step further. Let's take this one step further. How many of us consider ourselves to be above average drivers? So I'll ask you, Jeff, I'll ask you the same question. Do you consider yourself an above average driver?
Absolutely. Yeah. If you asked me, let's say 10 or 15 years ago, no, I would be at the lowest rung of driving. But there were a lot of mistakes that have gotten me to being just slightly above average at driving. I know that the gas pedal, at least here in the United States, is on the right hand side and the brake is on the left hand side. So I feel like that puts me a little bit ahead of everybody else. How about you, my friend?
Yes, you know what? I love how quickly you answered that one versus the hesitancy of the other. So obviously you're thinking about this. This was very reactionary, quick,
Yeah,
quick to the jump. You were highly confident in your answer right there. And Jeffrey, I don't think I know you don't own a Tesla
no.
because you would have not referred it to as a gas pedal. You would have referred to it as the go pedal.
Is that what they call
So,
that? No kidding.
well, the pedal or the accelerator because obviously there is no gas. So,
Yeah,
um,
good
but
point.
you think about this question, and I would get everybody out there. I would get everybody out there to think about this. How do you consider yourself? Do you think yourself as an above average driver? And the reason we ask that is because of a study done by AAA. When AAA, Automobile Association of America, asked this question of people, 73% of us responded, yes, we consider ourselves above average drivers. Now we can all do the math. There is no way possible that 73% of us can be above average. Average is right at that 50% mark, right? So 73% of us cannot be skewed above that. And I find that fascinating.
Would you put yourself after seeing a study like this, do you say, all right, well, so statistically speaking, this can't be possible. However, here's where I would put myself in that spectrum. Where do you think you fall?
Well, so I think this brings up a very interesting point called self-reflection, or being
Hmm.
able to look internally at yourself and to put some true analysis around it. So I am fully aware I am not an above average driver. And, in my role here at Schwab, I get to travel quite a bit for Schwab, and I've had lots of my Schwab counterparts travel with me. And I have not only been told by them, but by many people, including family members, that Robert, you're by far not the best driver out there. So yes, I've truly come to realize I am not in that 73%. And I think that speaks very much to how we should maybe look at ourselves from the investor standpoint, maybe the trading standpoint. Give some true reflection on, do I have the potential time, the wherewithal, the discipline to be doing lots of these things ourselves? And the answer
Mhm.
may be yes, maybe no, maybe, hey, I can do some of this myself. Maybe I got to find others to do some of this for me. Heck, maybe I need to actually just develop a plan around how I'm going to execute on some of my investments.
Yep.
So I like this. I like this study. I love that question because I think it's relatable to I uh, relatable to a lot of us in something we do every day. Potentially, we drive, and we're probably looking at the market, looking at our investments. Now, the key around this is to understand then what and why do we fall into? What traps do we potentially fall into around some of these decisions that make us less than optimal investors or less than optimal traders? And why does this happen? So I like the slide that we have here. I'm sure a lot of our audience has thought about left brain, right brain, or at least heard that concept before. Sometimes it's referred to as we have it on the slide here, inner brain versus outer brain. But what this comes down to is part of our brain is wired to be very instinctive, reactionary, emotional, as opposed to the other half of our brain, the outer brain, which is very logical. I think of Mr. Spock from Star Trek, right? Logical,
Mhm.
very process oriented. And when I think about this is what we need to think around our finances and our trading is maybe we need to skew our decision making more towards the outer brain aspect and try to tamper down that inner brain reaction.
Yeah. You kind of have to think too, what part of my life do I want to be logical? What part of my life do I want to be emotional? I know from being with other people throughout my entire life, they're like, "You're not really emotionally available, are you?" It's like, no. Why would I be emotionally available? Emotions are for losers if you're in the trading game, and they love hearing that. I'm sure you can imagine everybody that's ever heard that is just like, "Oh, swoon." But in your personal life, different, right? You do not want to be an outer brain person in your personal life where you're saying like you're interacting like a robot with your significant other. No, for that, you want to be inner brain. You want to be more emotion, more feeling type driven. But when you're making investment decisions, you have to be able to move from that inner brain to your outer brain, to the neocortex is where you're trying to go with that. So we'll give you a couple of ways that might help out and some tips and tricks along the way to get you from the inner to the outer when you're making an investment decision.
Jeffrey, you hit on it right there. And, simple rule that I think about is it's great to be emotional around things you can physically touch or hold. Or I like to say, if you can hug it, you can be emotional around it.
Yeah, I like that.
Think about friends, family, spouse, kids, parents. Okay. How about
Yeah.
pets? Yes, your
Yep.
dog, your cat, you can hug them. You can hug a bird. They don't like it, but you can, right? Heck, you can be emotional around a car, a boat, a plane, a painting. Just don't be emotional around a 3 or 4 letter symbol. You can't physically hug those things.
Great insight, man.
Uh, So good stuff. So that's the thing. That's the concept we're going to get you to. How do you understand? How do you understand and realize when you're being a little bit more emotional? What can you do about it? To me, that's the big first step, having realization around it. Okay. Let's talk for a second, because We're going to talk about some of this today. Jeffrey, are there any other readings you have come across in your career around, we'll call it behavior of investing, that you would like to recommend to our audience today? Things that you've read or come across that, hey, if they want to get some more in-depth information, where would you guide them to?
Well, there's two things that I really, really liked. So the evolution of behavioral finance that we're talking about was started back in the 70s by Daniel Kahneman and Amos Tversky. Now, Amos has passed away, but Daniel Kahneman is still very much alive. And recently he wrote a book. If you want to write it down, it's called Thinking Fast and Slow. Daniel Kahneman, Thinking Fast and Slow. But it's a thick book. It's a great read. You're going to have a wonderful time doing it. Rob, I know you've read it as well as all the other members on our team. But if you want kind of the abridged version, something a little bit more of an entertainment value, Michael Lewis, who did Fast Boys, who did Liar's Poker, who did Moneyball, he wrote a book on the exact same subject called The Undoing Project and references a lot of the same stuff that Daniel Kahneman does in his book, Thinking Fast and Slow. So if you want more of an entertainment piece, take a look at The Undoing Project. If you want to then step it up, get a little bit more information, take a look at Thinking Fast and Slow. I've read both of them. I read The Undoing Project first. I then read Thinking Fast and Slow, and I thought that was a very natural progression. Easy introduction and then a deeper dive, but both of them are highly entertaining. So if you have the opportunity, take a look at those at your local bookstore.
No, hey, I like that. Good ones there. The two I always add to this area at Schwab, we have two podcasts. If you don't even want to go through the exercise of reading, all you have to do is listen and absorb. Uh, our podcast called Choiceology is fantastic. It's really built around this concept, some of the behaviors that we run into in the financial market, in our decision making. And then we have a sister podcast to that called Financial Decoder. And in that podcast, it's really taking some of these concepts and how do we make better decisions around it? How do you actually execute in your own personal finances around it? So I think we've given you a couple areas you can go explore more. There's obviously lots of information out there. All right, let's move forward then to what are some of these actual biases or behaviors that we bring to the table? How do we know that we're aware of them and how can we sort of overcome some of them? We're going to talk about three of them: overconfidence, the illusion of control, and the concept of loss aversion. And I know, Jeffrey, we have a couple other that you mentioned at the beginning that we're going to bring into this. We'll get into those also because I think there's obviously lots of them out there. I think I read recently there's well over 100 of these different heuristics that we bring to the table that keep us
Mm-hmm.
from making optimal decisions at this point. So to
And
me,
a
it's hey,
heuristic is, for the audience, a heuristic is kind of an error in judgment, if you will, making a fast decision. That's a heuristic. Why is it that our brains are programmed to not do what's in our best interest on a split second decision?
you got it. It's like going to the Thai restaurant and saying, "Of course, I'll take the Thai hot." You don't want hot. You just want medium. Maybe you want hot. Don't get the
Yeah,
Thai hot.
three chili
So
peppers
I'm
is a lot when you really think about it. It looks easy on your menu, but it's not so easy on the plate.
exactly. I'm speaking from past experience. So all right. So let's start. Let's talk a little bit about this concept of overconfidence. Um, I know, Jeffrey, when you and I have talked in the past, I really liked how you explained this. Can you maybe just walk us through what do we mean by overconfidence and how do you see it playing into our clients' lives?
Yeah, well, so let's do an audience participation one real quick. All right, so in your question and comments section, I'm going to ask you a question. You type in the answer, tell me what you're thinking. So today's Wednesday, it's June 3rd. We're going to finish the market on Friday, June 5th, which, by the way, is National Donut Day for those of you donut lovers out there. But I have a question. The market's been going up. Here's my question, and then you have to give me a level of certainty. On Friday, is the market going to finish higher than it is today? And what's your level of certainty? So if your answer is yes, it will finish higher today, all right, great. I'm only 5% sure, I'm not too sure. Or no, I don't think it's going to finish higher, and I'm 80% sure. So tell us, do you think the market is going to finish higher on Friday than it closed today? And then also add in your level of certainty. Now, where we talk about this overconfidence bias comes from the performance of the past. And that's why Rob and I made sure to highlight past performance is not guaranteed to give you future results. When you look at past performance, and it's very easy, I think, for Americans to especially make this mistake, they say, well, eventually the markets only go one direction. They only go up. Yeah, so far. I mean, America hasn't been around a terribly long time. We've gone through quite a few crashes, but our stock market's been around for less than 200 years. And if you look throughout history, let's say you go further back, not a lot of empires go on forever. Okay, if you can find one that you say, here's a group that's only gotten better throughout the millennia. I send it in your comment section. I want to hear about it. But if you think about all of the different dynasties, all of the different emperors, all the different eras, all of them eventually found an end. So what we tend to do is we say, well, markets will only go one direction, so I might as well put everything in the best performer. In this case, we're looking at small cap stocks. I'm not going to diversify. Clearly, putting my money in bonds, in cash, or just letting it get inflation is not going to get me the money I want. And if I did large caps, well, shoot, then I'm missing out on that extra $13,000. So back since 1925, I think is when this thing starts, if I just would have stuck with small cap, I would have been good. So here's what I'm going to do. I'm going to do something different than the rest of the market. I'm going to put everything on small caps right now. That way, when I retire, I'll have that much more money. But the problem is, if you take different chunks of time out of the equation, you're going to see different results. Let's say you would have gotten out at the bottoming point of the market during 1987, during the 2000 dot-com bubble. Well, you're now taking out a performance measure. And that's what I think we forget as human beings is our emotions are on this beautiful little roller coaster all the time. We go from enthusiasm to exhilaration. We've got our euphoria, comes into pessimism. Finally, we'll have our panic and our despair, and then it turns back into hope, and we repeat the cycle all over again. But when you're so focused on looking at the past and saying what happened then is going to happen now, you have some issues. If you take right now, the market had a very big pullback because of the COVID-19. Where did we look to try and get some information? Well, we look back to 2008, 2009. We also look back to the SARS outbreak. And then we look back into 1918, which is the Spanish flu. Our market did not act like any of those. Okay, it did something completely different. It had the fastest downward movement in American history, and it had the fastest upward movement from a bear market in American history. So that's why the overconfidence bias cannot be emphasized enough. I have to constantly remind myself, and I don't know if you're the same way, Rob, but I think to myself, Jeffrey, you teach people how to trade for a living. Whatever you decide to trade is going to be the right decision. You've done this every single day for the last 10, 11 years. Just go with your gut. That's my overconfidence bias creeping in. And I have to remind myself, no, I don't know any more or any less than anybody else out there. Take yourself out of this, remove that ego, and instead implement a plan, because a plan you can check. Your ego, you can't go back and say, like, what was my ego thinking on June 3rd at the time the market was closing? Should I really close out that position? So that's where my overconfidence bias tends to creep in. And before we get into our answers, Rob, I know you probably have a couple of examples that you've had along your trajectory of seeing clients or having overconfidence brought into the foray. What would you like to share?
Yeah, I guess I think about it a little bit more from a long-term perspective is, we can all see that, as the economy grows, our market grows. I think there's, some basic things around that, you know, there's a long-term trend there. Unfortunately, that long-term trend is not that perfect line up. It goes up and down along that line, that growth. And at times we can be emotionally shaken, either really positively or negatively based on short-term moves. I mean, you look at the pullback we just had, it gave up a significant portion of the all-time gains that we've had. And how did you react around that? You look at back in 08, 09, where we pulled back 50+%, and that can cause confidence to be shaken. That is the plan that you put forth truly going to be met to fruition? It causes uncertainty. So um, I truly liked a lot of the answers that we saw there. I'm glad we got nobody that says yes with 0% confidence or no with 0%. But Jeff, walk us through some of the responses that we received here and
Sure.
and what you're thinking around that.
Yeah, okay, so we got no one knows 50-50. Great. I got a yes at 70%, a yes at 15%. I got a lower at 70%. I got a no, so lower at a 65% certainty, lower at 65%. Friday will be lower, pretty certain the market based on how the market is not logical. So you kind of have a little bit of a mix. You've got on the high side of the yeses, you've got a 70% certainty. On the low side, you've got a 70% certainty. So nobody goes beyond the 70% mark. Then we kind of have a lot of weighing in around the 60 to 65 mark, and then some are even down at the 15% mark. So
Yeah.
when you see something like this, Rob, is there a theme that you kind of pull out in the level of thinking as math psychology is incorporated into what we're discussing today?
Yes. So the theme that I'm seeing here, just from the quantity of answers we have, is overwhelmingly everybody thinks the market is going to be lower on Friday. Like that is definitely the theme that I am getting through this, and it reminds me of something that Liz Ann Saunders said many years ago that I still remember to this day. Liz Ann is obviously Schwab's uh, chief domestic economic analyst. She's fantastic. I encourage everybody out there, please read her information. It is wonderful. She said a couple of years ago that it's much easier to make the negative argument than it is the positive argument. And I think that's always why we see that out there, that negative argument, why things shouldn't be the way they are, why things should go down and not go up. I still remember that today. And I think that bias is always out there.
Fear is a much stronger emotion than greed. People feel the effects of a loss much more than the benefits of a gain.
Absolutely. Absolutely. Let's build on this a little bit around overconfidence. Um, are there any other, I would say, biases that come into play that you think of that sort of lead into overconfidence, Jeffrey?
Yeah, there's two that come to mind. The first one is confirmation bias, and the second one is anchoring. Confirmation bias, and Rob, I've got to be very careful about this. And I talked to Kathy Jones, our chief strategist with fixed income, and I asked her, like, how do you make sure you're looking at the right news feeds? How do you make sure you're reading the right stuff? And she had said, well, I look at the things that I rely upon most, but I intentionally go to those I know I am not going to agree with, and I read them to make sure I don't have the confirmation bias. And what that looks like for me or for any of us out here that are viewing this, if you're reading through the newspaper and you are handpicking which articles you want to read, that's confirmation bias. If you're watching a news feed, for example, CNBC, Fox Business, Bloomberg TV, and you turn off a certain segment, that's confirmation bias. You're looking to get things that already confirm your preconceived notions. So one way to overcome that, read everything. When I'm reading through the Wall Street Journal, it takes me 2 hours every single day, but I read every single article, whether I want to or not, because I know that my confirmation bias is going to say, okay, only read about the tech sector, only read about the financial sector, only read about the healthcare sector, things that I might be interested in. But I got to make sure I'm getting every ounce in there. So confirmation bias is one of them. Anchoring is another one. And anchoring
I'm
can
going to
creep into
stop you
our
right
lives.
there,
Yeah,
Jeffrey. I'm
go
going to
ahead.
stop you. I'm going to interrupt right there. I think you bring up a really good point about read everything. And one thing I see quite often with investors, even our clients, is when they go research a stock. So when you go research a stock on our Schwab website, on schwab.com, we give you ratings on that stock from multiple different perspectives, different third parties, such as Morningstar or Argus or CFRA or Market Edge. And it's amazing to me how many people will only read the information from an analyst that agrees what they want to do, such as I want to buy this stock. I'm only going to read the people that are recommending it. And I always tell people, read the dissenting opinion. If read the person that dissents with you, because they're going to point out risks that you are not seeing. And if you are comfortable with those risks, then you probably have a decent idea.
Yeah, great mention. It takes energy too. So think of, if you're like, this is an easy decision, that's a red flag. If you're at any time saying, well, this is a no-brainer, stop. Stop whatever you're doing. Do not take the next move until you read, like Rob said, a dissenting opinion. Because at no point should you be like, look at all these green boxes are getting checked everywhere. This is great. There should be something that should try and be in the back of your brain that goes, okay, wait a second. This seems too good to be true. And chances are, if it seems too good to be true, it is. So
You got
absolutely
it.
read the
Some of the
dissenting
most
opinion.
dangerous, some of the most dangerous words in investing. It's a sure thing. Run the other direction.
Yeah, words like guarantee, I'm going to head the other direction. Yeah, I remember there was a saying that one of our regional investment strategists used to say. He's like, I guarantee you, I can only, do one guarantee. I guarantee you the market's going to open tomorrow at this time of day. And we're like, but then we're like, well, wait a second. That's not actually true. There are times where the market doesn't open at that time of day, where, during World War II, we were shut down for quite a few weeks there. So there is no guarantee in finance. There's no guarantee that the markets will open up at the same time, although they've got a pretty good run. Um, but if you're finding yourself at any time, especially when a friend mentions things, I notice this a lot. I get overconfidence when my friends who are closest to me say, hey, here's something you should check out, because I think, oh, they have my best interest in mind. They've probably already done the research. And so I am naturally on the side of, yeah, let's do it. And I have to step back and say, well, they're your friend. Don't think because they're mentioning an idea that you now have to agree with it. You can find reasons why it doesn't work. So take a bit of time and do that.
Absolutely. So, Jeffrey, I know you were going to mention a second one. Let's talk about your second additional um, bias, uh,
Yeah. Anchoring.
anchoring.
Anchoring
Perfect.
is one of them. Anchoring is the reason why support and resistance levels work. Anchoring is us expecting something that has happened or that was mentioned to happen again. So if you were to go up to this giant gumball machine and they said, could you guess how many gumballs are in here? If somebody at the front had said, my 12-year-old child guessed that there were 100, even though you're not taking that person's opinion into very much weight, that mention of the 12-year-old and the number 100 is going to play in your decision. So you'll say, okay, it's not 100. How much higher is it than 100? Instead of saying, no, flat out start all over again. I don't want to hear that opinion. Looking at the gumballs, there's probably about 700 of them. And what's kind of cool is with anchoring, we don't do good as individuals, but anchoring can be almost eroded, if you will, by a larger sample size. And this is quite an interesting study. And if you read The Undoing Project or Thinking Fast and Slow, you'll get this. As humans, if we guess by ourselves, we're not very good. But the more people that guess and we take that average, the closer we are to the real number. Isn't that fascinating? So if you make a guess at the gumball machine and let's say you say 50, All right. Now you ask 2,000 people to make a guess, and all those 2,000 come up with a mean answer of, let's say, 354. You're probably pretty close to the actual number of gumballs in there. Isn't that fascinating? I was blown away by that.
The collective opinion is sometimes the best predictor we have. Thus, that's the market. I love
There
it.
it is.
It's great. It's great. All right, let's move on. Let's move on to our second area here because we're actually getting a question that actually comes back to this whole second area that we're going to talk about called the illusion of control.
Mhm.
So, what is the illusion of control? Um, Jeff, Jeffrey,
Well,
how would you explain the illusion of control to somebody that's never heard this term before?
well, I would say, first of all, are you in any way superstitious? Is there something that you do every day or that you do when your favorite team is playing as you're a fan? Maybe you wear the same socks, you wear the same jersey, you paint your face the same. Perhaps when you're golfing, you will do the same little waggle of the club head. Is it that produces a win, or is it performance? And that's where illusion of control comes in. There's a lot of times, and if you think about Super Bowls, if you think about World Series, people say, I knew I shouldn't have worn my hat like that. I had the best. It should have been worn backwards. You know, when the third inning came around, I knew I should have twisted it backwards. I ruined it. And if you were like a psychologist, you're thinking, so let me get this straight. The Chicago Cubs are playing, and because you didn't turn your hat around backwards in the third inning at your home when they were in a different state entirely, you're the reason that they lost the World Series? Exactly right, Doc. Now you understand. That's the illusion of control. Very much anybody that's out there and you're superstitious and you're thinking, okay, I got to do like a double tap before I hit my space bar and then I log in for the day and I start placing my trades. That's superstition. That's the illusion of control. So I know you've got some information to share on the cost of waiting to invest or being superstitious about getting in the market or getting out of the market.
Yeah, I think you said it very well there. I love the sports analogy around it. It's confusing coincidence with actual correlation.
There it is. Well said.
And and one of the dangers I would say is, Schwab Live Daily is fantastic. We do a great job trying to get you real information. There are other financial channels out there that love to blur the lines between coincidence and correlation. And they think everything is correlated when it's just coincidence. So, because they need ratings. There you go. So the reason I put up this slide is we actually had this question about, it was actually geared around the fear of missing out, about, hey, I should have bought in back on March 23rd. Well, I'll say this, nobody knows when the low is happening as it's happening. We only know the low in hindsight. Okay. And if you know when the low or the high is happening, uh, as it's happening, I'm going to tell you right now, it is pure luck. And it usually meant that you've picked the low the last 20 times on the way down. Okay, this is the low. Nope, now this is the low. No, this is the low. Or this is the high. So I think around this whole concept, I think this is more from the investing point of view is, think about how much of your money should be exposed to equities. I mean, that should be long-term invested growth. Obviously we saw from that earlier chart in equities perform better over the long haul. And, what we're showing here is, hey, if you had perfect timing when putting money into the market, or even just average timing, just bought it whenever you got the money, or you actually bought in at the worst possible time throughout the years, your performance still is actually better. So it's really about, hey, if you make, a poorly timed optimal decision, as opposed to just avoiding a bad decision, in this example, we talk about, hey, if you need money for the long haul, staying in cash is a really poor decision. It's not going to get you the growth you need. Okay. It'll be safe, but it's not going to get you the growth you need. Okay. That's a bad decision over the long haul. Getting invested, even making you know, poorly timed good decisions outperform when it comes to investing. So I think, you know, I would point out that, yeah, you missed the bottom, but hey, if this is truly money you need long term, you know, think 20 years down the road or more, heck, even probably 10 years down the road or more, it's probably more important just to have that money exposed and worry about the timing around it.
Well said.
So any, Jeffrey, any additional comments around that concept?
Think about this. When was the best time to plant a tree? And you're like, oh, it would have been nice to have it grown already. Yeah, the best time was 20 years ago. Second best time is right now. So if you're sitting on the sidelines or you're not sure of what to do, start toe dipping in there. Maybe you don't throw everything into the market all at once, but maybe you put 1/5, a quarter of it into the market now. Wait a couple months, see how it's done. If you're wrong, great. That's why you left the other 3/4 out of the market and you can put it in now at a lower price. If you're right, great. I'm glad I had some exposure as the market was going up. So, best time to plant a tree has already gone. The next best time is right now.
You got it. One of my favorite fortune cookies I received in my life is that quote. So perfect. And dollar cost averaging is a way to think about it. I like that analogy. I like that concept. And let's talk about our last concept here called loss aversion. Um, Jeffrey, maybe give us an example of what this is, what this means. How do you see it when you talk with clients?
Well, it's coming back to what I mentioned earlier. The loss that you feel, and this research has shown this, you feel a loss 1.5 to 2 times more than you feel a gain. So we're predispositioned towards the fear of avoiding loss, or you want to be loss averse, which works out well if you're like, okay, there's a cobra in front of me, I've got a hippopotamus behind me, and I've got a tiger to the left of me. What should I do? Yeah, loss averse, run right. Pretty straightforward answer. But when it comes to the market, that's a deeper level of thinking. If you're overthinking what's going to happen, and I know, Rob, you've talked to customers like this, there's folks that I had worked with who got out of the market at the lows back in 08, 09, and they would not get back in. They go, no, I'm waiting for the crash. I'm waiting for it to come back. I'm waiting for it to come back. I don't want to get in and then lose the money. Okay. I'm not so much worried about missing out on the gains. I don't want to lose the money. All right. Well, if you really think about it, you are losing money. You're either losing money to inflation or you're losing money to underperformance by being in cash. So you can make very, very irrational decisions because you're worried about a loss. And that's why I don't know if you do the same, but Rob, I have my net worth, I have my retirement and all of that handled by somebody else because I know that if I'm the one in control of it, I'm going to make very different decisions than I would if I were putting it in somebody else's hands. So the fear of loss is something that you want to be careful of. And if it means doing the phone a friend, which I certainly do if I'm on a trade and I'm like, okay, I can't see the forest for the trees right now, I do my phone a friend. I call up my buddy Tim Bonet and I say, hey, Tim, I'm too far in it, buddy. I need you to tell me what to do. He'll tell me, and that's what I go with. So if you need to utilize your phone a friend, go ahead and do that. But the fear of loss can also play out, and I'll wrap up what I'm going to say with this is as it's going up, you can fear missing out on that gain, that very small 2% gain that you have. And so your fear of missing out on a loss is actually missing out on capturing the gain. Two pillars of successful trading, my friends. Number one, definitely limit your losses. Don't let a 5% loss turn into a 50% loss. But number two is let your winners run. You have to be able to let that 2% grow. And if you're worried that I'm going to lose that 2%, like the chart right here says, you're going to make some very irrational decisions. Selling winners too early, holding on to losing investments too long, feeling like you're married to a position. So I've got an example if you're interested on how you can look at holding on to a losing investment too long and the way to get out of that. But Rob, I do want to give
Yeah,
you a chance to comment.
let's pause. Let's pause before the example because there's two things that you said, Jeffrey, that I think are tremendously important. One, getting another set of eyes to look at your situation. Okay, so you're removing somebody that is not emotionally connected to your situation, having them put some analysis and thought into it. I talked about you called that phone a friend. I think that is a very simple step a lot of us can do. Okay. I know here at Schwab, our financial consultants, we have got lots of financial professionals that are willing to sit down with you to talk about what you're trying to accomplish, look at your plan that you've created. And if you haven't created a plan, maybe help you develop a plan around what you're trying to accomplish. What are your goals out there? And show you different paths to potentially get there. Okay. The second thing I heard you say again is coming to that realization that, hey, maybe you don't have the time or the emotion or the discipline to potentially handle everything yourself. And it's okay to find somebody else to potentially help you with it, to offload some of that, to remove your emotion from that decision-making process. Okay? There's nothing wrong with that. And I think that's always something to explore. And I think where I see individuals go wrong is they go into it without trying to define, hey, what do I need this person to do for me? What do I need them to do? Define that up front, define those parameters up front, and then make sure it is a fit. Okay. Yeah. I want to address one question here because I think we had this question earlier and I wanted to come back to it. And it was really around how do you define yourself as an above average investor? And it was stated, is it the rate of return? And I would say, no, it's not just that. Okay. Yeah, rate of return is important, but I think it also plays into a couple other things. How much risk are you accepting to get that rate of return? If you have two investments, one returns 10%, the other returns 20%, which one's better? Well, the answer is we don't know. How much risk did they take to get there? If the one that returned 20% took 5 times the risk of the 10% investment, I'll tell you, your test 10% is your better return. Because if you keep on doing that over and over and over again, eventually the 20% investment is not going to work out. Okay?
Law
So
of
I
large
think, I
numbers.
think, yeah, it's different if it's just a one-off situation versus if it's something that you're going to try and repeat over time. So I think when you think about what makes an above average investor or investments, it's how much risk are you taking to get the returns that you have? And then secondly, determining what rates of return you need. You may need a completely different rate of return than I do versus client A versus client B. That what returns do you need for your goals to be accomplished? Your goals may be completely different than mine. And I think everybody wants to benchmark themselves to, an index in the marketplace, but you got to ask yourself, well, hey, does the risk and return of that benchmark actually satisfy what I need to have done with my money? You need to get more personal on that. And that's where I think developing a financial plan around your investments and developing that with somebody to help you uh, quantify that is tremendously important.
Absolutely.
So Jeff, you said you had an example. Walk us through this example.
All right, here we go. This is probably going to save some people out there. So if your friends and family need this example, feel free to share it with them. But if you're in that situation where you feel married to a particular company, right? Maybe you've got a little bit of a loss on it, or you've got a little bit of a gain, but it's not doing as well as your other investments. And you're like, I got to be honest, I've held on to this thing for so long that I just cannot seem to remove myself emotionally from it. And that happens. That's okay. Here's something you can do. Think of it this way. If Jeffrey were to go to your home or your dwelling or apartment or condo or townhouse, wherever you live, and I have a suitcase, and inside that suitcase is $1 million. Now it's going to be in hundreds because if it's in dollar bills, I would need a pallet. Fun little fact there for those of you who are into the monetary side of things. But I've got this briefcase, It's got $1 million in it. And I go up to you and I go, hey, this is your money. And you're like, oh, thank you. And I'm like, but before you take the money, there's two stipulations. And of course, you're thinking, great, I knew it. I knew it. He couldn't just give me the free $1 million. Why does this happen to me every time? I'll give you the money, but here's the two things that you must abide by in taking the money. Number one, you cannot keep it in cash. You cannot put it in your mattress. You can't put it in a savings account or a CD. You can't put it in US Treasuries. In fact, you have to put it into a stock or you have to put it into an ETF. So that's your first stipulation. This money is yours, but you have to put it into a stock or an ETF. The second stipulation, you have to make that decision right now. Is the position that you've held on to the one that you put the $1 million in? If the answer is no, then why are we still in it? If you wouldn't put money in it right now, why should we keep money in it for tomorrow? So if you're having some issues with that, I've been in that situation. I have to do that to myself. I go, okay, wait a second, Abelos, pull it back. Somebody gives you $1 million. Is this what you buy? Is this where your opportunity's at? And a lot of times my answer is no. And I go, okay, great. Mark it and move on. It's going to hurt when you try to look back at it and think, oh, I should have done it. It could have been 2%. Mark that stuff and move on. But that's what I found the best way to remove our past from a position is to say, somebody gives me money right now. What do I do with it?
I like that. I like that. I know there's lots of ways to think through that process. I like that analogy around that. I'll give our audience one more way to think about that. It's just asking yourself this question: is this security still playing the exact same role in the portfolio that it was when I originally purchased it? And
Oh,
if you
nice.
cannot define the role that this security is playing in the portfolio, like you said, maybe it's time to get either removed or replaced.
I love that.
Yeah. All right, we went over lots of different behaviors, biases that we bring to this whole investing and trading equation. Let's leave on an extremely positive note. How do we start to overcome some of this? Um, why don't we do it this way? Jeffrey, why don't you give us your top thing you tell clients on what they can start doing to overcome, and I'll give one, and then we'll wrap for the day.
I
So
like
what?
it. So one of the things I would say is I'm going to gear mine towards step three. Make a plan, put it into action, and stay on track. That last part, stay on track, gets to be very, very difficult. The reason being, a lot of us think staying on track means do nothing. Set it and forget it. Don't look at it ever again. Well, that's not true because as the market goes up and down, you want to rebalance. So the big thing I like to remember to highlight for folks is on step three, remember to make adjustments. You can look back and there's tons of books written on great trading strategies. And if you would have implemented those trading strategies during the 10-year time span when that book was written, you would have a lot of money. But if you move that same strategy forward 40, 50 years, you could be losing a heck of a lot of money. So you have to make constant adjustments. If you've got a great trade strategy, I think that's wonderful. Remember to make adjustments. If you've got a great investment plan, that's wonderful. Somebody gets married in your family, you have a child, you get retired. Now that's a key indicator that it's time to make adjustments. So remember to make adjustments. What about you, my friend?
It's interesting. My mind immediately went to number three on there. Maybe we should make that number three our number one. And I put up a slide here that shows our seven fundamentals to success around investing. And obviously the first one is, hey, before you start doing anything, sit down and think about what you're trying to accomplish. What are your goals? And then start developing an actual plan or roadmap to get there. And to me, I think that's very important. And what you spoke about there, I think fits very well into our sixth fundamental rebalance. Go back and look at what you're doing and rebalance the portfolio, your investments to are they still meeting your goals? I'll end this on our last one though. I think it's ignore the noise. I think that is, uh, to me, one of the more important items today because of how quickly and easily we can get lots of information and how quickly some of the information we absorb may not actually be material to what we're trying to accomplish. And it can actually, a lot of what we absorb through financial media or even social media is written to stoke our emotions, and they try to capitalize on coincidence as opposed to actual correlation, and that can be very deadly when it comes to our finances. So I would say learn to tamper down some of that noise out there. Maybe turn down the volume. Don't read. I like to say if you take a quick emotional reaction to something you've read, hey, put it to the side for a second here. Maybe revisit it in a day or two, or ask somebody else. Hey, what do you think about this? What's the counter argument to this? Because it was probably written to get you to click on something, to come back and tune in later, so they can continue to get readings or ratings or whatever. Be very, very careful with that approach. So this this is our behavioral finance show for today. Uh, Jeffrey, any last words before we wrap up?
Keep it simple.
I
Above
like it.
all, keep it simple. And thank you very much, Rob, for having me on the show. It's been a pleasure getting to collaborate with you as always.
Absolutely. Thank you. I love it. Keep it simple. Thank you, everybody, for tuning in. We loved all the questions and comments today. Please tune in tomorrow. Schwab Live Daily will be back, obviously, tomorrow at 10 a.m. Eastern, 7 Pacific.